everyone, welcome to Concepture Academy. Today we are going to discuss a very important topic. You would heard that accounting is often called the language of business. So today we will explore this language and the rules behind it, known as generally accepted accounting principles, commonly known as GAAP. Let's start with the definition of accounting. Accounting is the process of recording, classifying, summarizing, and reporting financial transactions. Accounting actually helps businesses record every transaction. It groups similar ones, summarizes them into reports, and shares them with those who need to know. It provides a full picture of a business' financial health and activities, allowing informed business decisions. So main activities involved are recording, classifying, summarizing, and reporting. Every time a business buys, sells, pays, or earns money, the transaction is recorded in books or software. For example, when a customer pays for a product, it is recorded in the sales book. The second important activity is classifying. Similar transactions are grouped together. For example, all expenses like rent, electricity, and salaries are grouped under expenses heading. Then we move towards summarizing. All the recorded data is then summarized into reports like income statement and balance sheets. These reports help show the overall financial position of a business. The last step is reporting. These summaries are shared with stakeholders like owners, managers, investors, banks, and the government, so they can see how the business is doing. The question arises that why accounting is so important. Actually, it tells the financial story of a business. Think of accounting as telling a story with numbers. Just like a story has beginning, middle, and end, accounting records where the money came from, how it was used, and what is left. So from accounting records, we can see if the business is profitable or not, growing or shrinking, stable or in trouble. So actually, it helps in decision making and tracking the performance of business. As a business owner, you can use accounting data to decide whether to expand, cut costs, or to invest more. So it actually helps in answering the key questions that are we earning more than we spent? Which product is most profitable? Can we afford to give bonuses or discounts? So without accounting, decisions would be based on just guesswork instead of facts. So it is commonly known as the language of business. Just like we use language to communicate thoughts, accounting is the language used to communicate financial information. Whether you are talking to an investor, a banker, or a government agency, accounting helps everyone understand the financial health of the business in a standard way. So it creates not only the trust by showing the clear, accurate financial data, it allows decisions to be based on facts, not the guesswork, and make sure that businesses are answerable for how they are using their money. But here is the key question, that how do we make sure accounting is done properly, honestly, and consistently in every business? After all, different businesses could record transactions in different ways, and that would create confusion or worse, manipulation. That's exactly where GAPS comes in to ensure that every business prepares its financial reports in the same reliable way. So actually GAAP stands for Generally Accepted Accounting Principles and plays a crucial role in overall accounting process. You can think of GAAP like the traffic rules for accountants. Just like drivers follow the same traffic signs to avoid accidents and confusions, accountants follow GAAP to ensure financial statements are accurate and clear, different businesses are compared fairly, and the reports are trusted by investors, banks, and the regulators. So without GAAP, each company could create their own version of accounting, and that would lead to chaos. So now that we know what GAAP is, let's look at its key principles, the core values every accountant follows. To ensure consistency and reliability in financial reports, GAAP is built upon certain foundations that include four basic assumptions, four core principles, and five practical constraints. And together, these assumptions, principles, and constraints shape the way financial information is presented. So let's explore each of them with simple explanation and real life examples. As I told you, there are four basic accounting assumptions, or in other words, we can say that these are foundations we assume to be true when preparing the financial reports. The first one is economic entity assumption. It says that business is separate from its owner or other businesses. For example, if the owner buys a personal car, it is not recorded in the company's books because it is something different from the business. The second one is monetary unit assumption that says that only transactions in money should be recorded. A happy customer review might be valuable for the company, but it should not be recorded in the accounting unless it results in some sales. Similarly, time period assumption says that financial reports should cover a specific time, say month, quarter, or a year. Like sales made in July 2025 must be recorded in July 2025 reports, not earlier or later on. Now the fourth one is going concern assumption. It says that the business will continue to operate unless proven otherwise. So the principle supports that every decision in a company is taken with the objective in mind of running the business rather than that of liquidating them. Similarly, there are four basic accounting principles that those are main rules to follow when recording transactions. The first one is revenue recognition principle. It says that record revenues when they are earned, not when the cash is received. So if you do a job in December but the customer pays in January, the revenue should be recorded in the month of December. The second one is matching principle, and it says that match expenses with relatable revenues in the same period. For example, if you sell a product in the March, record both the sale and the cost of the product in the same month of the March. The third one is historical cost principle that says that assets should be recorded at their original purchase cost, not at the market value. Like if you buy a land for rupees 100,000, you should keep it in the books at rupees 100,000 even if it is now worth at rupees 150,000. The last one is full disclosure principle that says that share all important information in financial statements or notes, because this information is very important for all stakeholders. Like if your company is being sued, this must be disclosed even if it hasn't been settled yet. Now we will talk about the five basic accounting constraints that practically limit or condition when we apply accounting rules. The first one is objectivity constraint that says that always use objective versatile evidence like receipt or invoice whenever you record something. Don't just guess the value of inventory, count it and get it documented to support it. The second one is materiality constraint that says that only record things that matter significantly to decision making. For example, you wouldn't record every pencil used, but you would record buying a new computer. The third one is conservatism constraint that says in case of doubt, choose the method that shows lower profits or higher liability. It is possible that a customer might not pay, so record it as a bad debt now even if it is not confirmed. The fourth one is cost benefit constraint that says that the benefit of reporting information should be more than the cost of reporting it. Don't spend thousands of dollars to track something worth only a few rupees. The fifth one is consistency constraint that says use the same methods across periods unless there is a clear reason to change. If you use straight line depreciation this year, use it next year too unless you disclose and explain the change. Okay, now have a quick review of both these concepts. We learned that accounting is more than just numbers. It's about telling the financial story of a business. So without a common set of rules, that story could be confusing or even misleading. So that's where GAAP comes in. So think of GAAP as the grammar and punctuation for the language of accounting. So it ensures that financial reports are clear, consistent, and comparable across different companies and industries. That's all for today's lecture. I hope you now have a clear understanding of what accounting is and why knowing GAAP is so important. So let's keep learning. Subscribe to Concepture Academy for more clear and simple lessons. Also follow us on Instagram and Facebook, and please do not forget to leave a comment and tell us what you want to learn next. Thank you.